I can't believe what the credit card companies are about to do. I'm your host, Steven Van Metre, and thanks for joining me today. And with many small businesses still struggling since the pandemic, well, thanks to the credit card companies, things are about to get worse. Let's check this out as we head over to the National Federation of Independent Businesses, just so you can understand just how bad it is for small businesses as we look at their optimism index, which is now back where it was just before we see this big surge in optimism back in 2016. And I want you to note that optimism up through the mid 2000s was very strong, and we're actually at pretty low levels. We're not down to pandemic lows here at around 90, but we're at 95, and the trend is heading lower, indicating that small businesses are not optimistic about the future. They have good reason to. Of course, thanks to credit card companies, as we'll soon see, well, they're going to have even less reasons to be optimistic. Let's keep going because, if we look at things they should be optimistic about, at least from an economic standpoint, well, job openings are near record as the labor market emerges from the Omicron disruptions. There were 11.3 million job openings in January, according to the Labor Department. But if you think about it from a business perspective, if you have a lot of job openings, what does that mean? That you have positions that aren't being filled, that you can't fill, and that is a challenge. Again, adding to the lack of optimism that's out there. And last year, workers quit their jobs at the highest rate on records back to 2000, the Labor Department said. And that shows Americans were willing to leave employment and search for better wages or more desirable perks, including remote work, according to economists. Now, you might say, well, that sounds really good. But again, from a business perspective, perhaps if you work in HR or you handle training for new employees, you know how difficult it is to not only find people, but get them into system and then train them so they can do the job. And for small businesses with high turnover, well, this isn't actually a very good situation at all. And so what we find so more remarkable, according to Zero Hedge, is that amid the continued tightening in the labor market, the bump in job openings meant there was a new record of 4.8 million, ignoring last month's upward revision, more vacant jobs and unemployed workers in January, confirming that the U.S. Labor Department remains woefully, in fact, cracked. And so again, we talk about what this situation with small businesses is, and now you're about to see what Visa and MasterCard are going to do. According to Wall Street Journal, who headlines that Visa and MasterCard prepare to raise credit card fees, and the increase is delayed during the pandemic, mean many merchants will pay more when shoppers use credit cards. Interchange fees account for most of the increase as merchants pay these fees, which are set by the card networks when shoppers use their card. The fees go to the bank that issued them. Though invisible to shoppers, interchange fees are a constant source of aggravation for merchants. Their interchange costs have ballooned in recent years, along with the popularity of reward credit cards, which typically carry higher fees to cover the cost of travel perks and other benefits. But networks, quote, honor all cards rule mean that merchant who accepts one Visa card must accept all of them. And Visa and MasterCard fees will apply to many online consumer credit card purchases, according to a document people were familiar with. A Visa spokesperson said merchants can avoid these higher fees, if they provide certain transaction data and use token services that mask card numbers. And here we're starting to see what the credit cards really want, and that's your data and your shopping history, because it's really valuable to sell to merchants. Well, what you'll be willing to buy next. But still, fees are headed up, and according to MasterCard, estimates their interchange fees will result in a net annual increase of around $330 million for merchants, if you can only imagine how much that is and how that will impact even the smallest businesses. But if we look at what else is going to hit small businesses aside from just credit card fees, well, you would hope that with higher prices, they would be able to pass these fees on. But we're seeing early signs the fact this inflation story is headed lower. Let's check this out. This is the delivery time from the Philadelphia Fed Diffusion Index. It's a Federal Reserve data point, and I've shown that in blue against the Consumer Price Index. So what you see is when the blue line is rising, the trend is rising, that means delivery times are lengthening. It's taking longer to get goods and services from one point to another. And when it's falling, delivery times are shrinking. And I want you to note here that we can go all the way back to the 1970s, see delivery times falling, and then with a lag, you see the CPI falling. Here in the 80s, delivery times falling. Then with a lag, the CPI falls. You see it here in the late 80s, early 90s. You see that happen again. We see that in the 2000s. And we're starting to see indications that even after 2018, where delivery times went down and we see inflation heading lower. And now you see delivery times looking like they're peaking. But there's one thing that the Philly Fed also looks at, and that is future 6-month forward expectations. And you can see inflation for businesses is going to go away. They're not going to be able to keep these costs built into those products, because here you can see the future delivery times. And you'll note here in blue, and then with a lag, what happens, you see a peak in the CPI. Remember, the CPI is a lagged indicator. Here you can see a bottom, and you see CPI at a low point. And now future delivery times are projected to collapse, and that means the CPI is headed lower too. And then we also look at crude oil, which is validating this, as we see Cushing stocks continue to drop near operational lows. And in fact, if you're concerned about your portfolio dropping to new lows during a bear market, well, be sure to check out Portfolio Shield. I'll put a link in the corner and in the description below. You'll be glad you did, because the data is now showing that perhaps crude oil is indeed starting to peak. Check this out. We've got the Department of Energy data today showing that Cushing inventories dropped 585,000 barrels, the ninth weekly draw on the low. We see gasoline inventories down, distillate inventories down, crude inventories down, and that would then suggest that perhaps prices are even headed higher. But as I've shown, and I'll show you again, well, that's not exactly true. Here we can see when Cushing, Oklahoma's total crude stocks in blue hits new lows. Well, that changes, of course, what happens to prices. Look at 2014, mid-2018, and now, and here we go over to the Federal Reserve database and pull crude oil prices. What do we see in mid-2014? A peak in prices and they head lower. What do we see in 2018, mid-2018? A peak in prices, they head lower. And now we see a peak in prices, and the broad belief is they're only going higher. But when you start factoring a higher dollar into this position and high prices, what does that incentivize foreign producers to do? Well, that's export to the United States and take advantage of those high prices. And of course, as we looked at recently, as oil comes down, well, that is also brings treasury yields down and tightens financial conditions up. And so that also indicates, as we've talked about recently, that these are a lot of the markers that we saw heading into the great financial crisis. But small businesses right now are being squeezed and about to be squeezed even more. And next time you go to the store and use your credit card, well, now you know why they might cringe when you hand them your plastic. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now. The content of this video is private education information only. It's not intended to provide investment or other advice. This video will have to be construed as recognition or solicitation, buyer selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, business expressed in this video that do not affect the Outlets Financial Advice Inc. or Steven Van Metre Financial.